Welcome to my YouTube channel, The Executive Outcomes. My name is Michael Mwansaliova. I'm yet to present financial accounting relating to assets, liabilities, capital, and accounting equation. To start with, let's look at what a business entails. A business can be taken to be any institution concerned with manufacturing, resale, or supply of goods and services. Others will say it's an organization using resources to create goods or services for customers. Furthermore, it can be defined as an organization providing jobs for people. Finally, we can say a business can be described as an organization which invests money or resources in order to make profit. Since we have mentioned profit, let's try to understand what we mean by profit or loss. A profit is simply the excess of income over expenditure. On the other hand, loss can be defined as excess of expenditure over income. Let's try to understand what we mean by assets and liabilities. Learning how to account for a business involves building up a clear picture of what a business consists of. For instance, assets. Assets can be taken to be anything of value which belongs to a business, whereas we have a number of classifications relating to assets. We have non-current assets. These are items acquired by the business which is to be used over a long period of time, such as buildings, furniture, vehicles, etc. For current assets, these are taken to be properties of the business which are short-term. They value within a short time, such as stock or inventory, debtors or receivables, prepayments, cash in bank, and cash in hand. Let's look at liabilities. A liability can be taken to be an item that the business uses from others, and it is the liabilities that are representing a burden to the business, the owners of the business to repay or clear the obligation to the others. Likewise, what are some of the classifications of these liabilities? When it comes to classification of liabilities, we can classify them broadly into two. One, non-current liabilities. These represent amounts the business owes which are to be paid over a long period of time, such as over 1 year or 5 years. Bank loan. What of the current liabilities? These are amounts the business owes which are to be paid within 1 year, such as creditors or payables, expenses owing, or bank overdraft. One important concept about business is the business entity concept. This concept relates to limited companies, partnership, or sole traders. In this regard, the law recognizes no distinction between sole trader or partnership and its owners. However, for accounting purposes, the business must always be treated as a separate entity from its owners when preparing accounts. Let's move on to look at what is known as the accounting equation. The accounting equation shows a relationship between assets and liabilities of a business. Therefore, an accounting equation states what the business has in terms of assets and liabilities, which must be equal to each other. Hence, we have assets is equal to liabilities. Let's look at asset liabilities in the tabular form. What type of assets are you expected to find in a business? Under assets, we can have cash, we can have accounts receivables, office supplies. The business can own land or office equipment. Under liabilities, the business can have accounts payables or creditors. We have also equity covered by common stock or ordinary shares. We can also have retained earnings, giving us total equity. So we have on the liability side equity and liabilities. So indeed, for an accounting equation, is best stated as assets is equal to equity or capital plus liabilities. Why is it so? Since a business can owe money to or be owed money by its owners, for a business, then we find that we have these two broad categories of items. Those that are owned by the business are assets. Those that are owed by the business are liabilities. Among the liabilities, we have equity or capital as a special liability because it represents the interests of the owners. Going by the separate entity concept, the owners are divorced from the business, or the business is divorced from the owners. Therefore, the interest represented in the business, known as capital, is a representation of what is owed by the business to the owners. Because when the business closes, the owners can lay claim on their assets. For a business to get started, it needs resources. That's another point. So when one invests money in the business, it is called capital. This capital is an investment of money with the intention of earning a profit. Therefore, the business owes capital to the proprietor. The capital invested is therefore a form of liability to the business, as I've already emphasized. This leads us to assets is equal to capital plus liabilities. Let's see how this accounting equation is affected when capital is introduced. Assuming that cash is being introduced into business to the tune of 100,000 kwacha, then we see that the asset of cash is created. So this 100,000 will be owned by the business, but the owner is like it's lending the business 100,000, therefore representing an interest in this business to the tune of how much is financed. We have 100,000 kwacha under capital. So when you look at this equation, assets is equal to capital. 100,000 equal to 100,000, which is representing in finance. Let's look at an example where goods are sold at a profit. So we end up having retained profits or retained earnings. Let's say that we had stock that cost business 3,000 kwacha, and then we have managed to sell the same stock for 4,000 kwacha. What has happened is that the value of 3,000 in terms of stock is going out of business, so we see a negative under assets. Then the value of cash, let's say you have sold for cash, the value of cash to the tune of 4,000 is coming into the business. Okay, so there is a difference of 1,000, 4,000 minus 3,000, which is representing an income, a gain on the transaction. This gain on the transaction is a profit. The profit has a potential of increasing capital. So capital is increased by 1,000. The investment increases by 1,000. So that's the net effect that we see there. An income in form of cash, okay, which is a profit, excess of expenditure, excess of income over expenditure. We spent 3,000, we have gained 4,000. There's an excess of 1,000. That represents also an increase on our investment. It builds up our investment. The profit builds up our investment. Let's say we have purchased an asset by the business. We purchase an asset by the business. So using cash. So we pay 20,000. So means cash moves out. The asset of cash reduces by 20,000, and we gain the furniture whose value is 20,000. Again, the asset increases by 20,000. The asset side reduced by 20,000 by cash going out. The asset side at the same time increased by 20,000 by having the value of furniture to the same tune coming in. Example number 4. We have the net assets. Assets is equal to capital plus liability. Okay? So have 120,000 given by capital plus liabilities. Capital amounting to 100,000, liabilities amounting to 20,000. So the net asset is given by assets minus liabilities, representing the net worth. So we have 120,000 minus 20,000, giving us with 100,000, which is the net asset, which is the capital. Increase in net assets, which is profit increases net profit, net assets rather, while net loss reduces net assets. Example 5. What happens when you have drawings? Let's say we withdraw 10,000 cash for personal use. What is the implication of the accounting equation? The 10,000 cash is reduced, or we move out cash from business, so the asset of cash reduces by 10,000. And since we are reversing our investment, our capital also reduces by 10,000, representing disinvestment. Example 6. Buying goods on credit. Let's say we are going to buy stock amount worth 50,000 kwacha, what happens to the accounting equation? When we buy stock on credit, the asset of stock increases by 50,000. So stock comes in worth 50,000, the asset increases by 50,000. Whereas now we have a burden to pay this 50,000 to our creditors. So the liability increases by 50,000. Again, the accounting equation balances. The business equation can be summarized by this relationship. Say profit earned in current period is equal to decrease when there is a loss or increase in net assets in the current period, plus drawings in the current period, then minus capital introduced in the current period. So why do we add drawings in this particular relationship? Drawing is part of your amount that the business had. So with the increase, for instance, in net assets, plus the drawings, which represent what the business has been made up over a particular period of time, minus what we initially introduced as capital, leaves us with what is the profit earned in the current period. What have we gained? Remember, drawing was part of your wealth that the business had. So when we are looking at what is the net gain in terms of profit earned, we add increase in net asset plus drawings, then subtract capital introduced. So this is what the business equation will give you. So we can say profit is equal to investment plus drawings minus capital. Thank you for listening to my presentation. Remember to subscribe to this channel and like it. See you next on the topic of financial accounting.